Silver is no longer trending, and that matters more than most people realize. After an aggressive move higher, silver has now spent meaningful time consolidating in a broad range between roughly $70 and $80. Volatility has compressed, momentum has slowed, and liquidity has thinned out. This is typically the phase where impatient participants get chopped up and where the next large move quietly sets up. This is typically the phase where impatient participants get chopped up and where the next large move quietly sets up. What happens next is unlikely to be gradual. History suggests silver resolves these structures violently once enough leverage, positioning, and complacency builds on one side of the market. So the question isn't whether silver moves, it's who gets forced when it does. And more importantly, what does this moment mean depending on your time horizon? 2. Market context and scope. In this video, we are analyzing silver as both a financial asset and a physical commodity. That distinction matters. Silver trades as a monetary metal, an industrial input, a volatility instrument, and increasingly, a liquidity barometer. This analysis is not about predicting tomorrow's candle. It's about understanding where pressure is building, how different participants are positioned, and what conditions would shift probability toward continuation or failure. Silver matters beyond day-to-day price movement because it sits at the intersection of monetary credibility, industrial demand, financial leverage, and physical supply constraints. When silver stops trending and starts compressing, it often signals indecision at the macro level, not clarity. 3. What just happened? Facts. First, let's start with the observable facts. Silver surged aggressively into the 70s, driven by a combination of broad commodity strength, monetary debasement concerns, rising physical premiums, and speculative momentum. Following that move, price failed to continue cleanly higher and instead entered a wide consolidation range, roughly bounded by upper resistance 78.80, lower support 70.72. During this period, daily volatility declined, volume tapered, momentum indicators flattened. This is consistent with distribution and reaccumulation occurring simultaneously, different players, different time frames, different incentives. Importantly, there's been no decisive breakdown. There's been no confirmed breakout. Open interest has remained elevated relative to historical norms, and margin requirements remain tight relative to recent volatility. This is not a resolved market. It is a loaded one. 4. Technical roadmap. Liquidity. First, indicators. Second, from a technical perspective, silver is currently defined by range control, not trend continuation. Key observations. The 70-72 zone aligns with prior breakout structure and high volume acceptance. The 78.80 zone coincides with prior rejection, thin liquidity, and gamma sensitivity. Price is oscillating around short and medium-term moving averages rather than respecting them as trend guides. That tells us something important. This market is not being driven by indicators. It is being driven by liquidity pockets. Above $80, there is relatively thin resistance. Stop-loss clusters from short positions likely sit just above momentum. Traders would likely re-engage quickly. Below $70, liquidity thickens. Forced liquidation risk increases. Longs who entered late in the move begin to feel pressure. This is not about whether silver looks bullish or looks bearish. It's about which side runs out of liquidity first. 5. Policy and macro catalysts. Now zoom out. Silver does not trade in isolation. Recent consolidation is occurring against a backdrop of central banks signaling caution, not easing real rates, stabilizing rather than collapsing liquidity conditions, tightening at the margins, and geopolitical risk remaining elevated but normalized. Markets initially priced silver as a hedge against loss of monetary discipline. But policy signals have since shifted toward higher for longer narratives, controlled disinflation, tactical liquidity injections rather than systemic easing that has reduced urgency, not conviction, in precious metals. This is critical. Silver tends to perform best when policy credibility erodes quickly, not slowly. Right now, the market is debating timing, not direction. 6. Physical versus paper. Market dynamics. This is where silver becomes more complex and more interesting. On the paper side, futures pricing reflects range-bound uncertainty. Volatility sellers have re-entered. Managed money positioning is elevated but not extreme. On the physical side, premiums in several regions remain historically high. Delivery times remain extended. Industrial users continue to secure supply forward. Asian demand has shown less price sensitivity than Western speculative flows. This divergence matters. Paper markets can compress indefinitely. Physical markets cannot. But physical tightness does not always translate immediately into higher futures prices, especially when liquidity is constrained and leverage dominates short-term flows. This creates latent pressure, not immediate resolution. 7. Time horizon framework. Before moving into scenarios, we need to separate participants by time frame. Long-term holders are focused on currency debasement, supply constraints, and industrial demand, are less sensitive to $10, $15 swings, view consolidation as potential accumulation, not failure. Short-term traders are exposed to leverage, margin changes, and volatility compression, face asymmetric risk in low volatility ranges, must respect liquidity and invalidation levels strictly. The same price action means very different things depending on your time horizon. Confusing those frameworks is where most mistakes occur. 8. Bullish scenario. What would have to happen? A bullish resolution from this consolidation is not automatic, but it remains a credible outcome if specific conditions are met. First, price behavior. For a bullish scenario to gain probability, silver would need to hold above 70.72 on a closing basis, reject downside probes quickly, with expanding volume, regain and hold above $80 with follow-through, not just an intraday spike. A clean acceptance above $80 would indicate that liquidity above resistance has been absorbed, not merely tested. Second, volatility. Bullish continuation in silver almost always requires an expansion in realized volatility, a breakdown of short volatility positioning, rapid repricing of options, skew. This is often triggered not by silver-specific news, but by macro shocks that force repositioning. Third, macro confirmation. Conditions that would support a bullish breakout include a renewed decline in real yields, explicit or implicit central bank backstopping of financial stress, a sharp deterioration in confidence around fiscal sustainability, or a geopolitical escalation that impacts energy, trade, or currencies. Silver does not need all of these, but it usually needs at least one. If these align, silver tends to move quickly with price overshooting technical targets before consolidating again. In that scenario, upside behavior would likely include fast movement through thin liquidity zones, aggressive short covering, temporary dislocation between futures and physical pricing, increased margin requirements after the move begins, not before. Importantly, bullish resolution would not eliminate volatility, it would increase it. 9. Bearish scenario. What breaks? If pressure continues. Now let's talk about the scenario many long-term holders prefer to ignore, but must still plan for. A bearish outcome does not require a collapse in silver's long-term thesis. It only requires liquidity stress. Here's what that would look like. First, price failure. If silver breaks below $70, fails to reclaim it quickly, and begins closing beneath prior high-volume nodes, then downside probability increases materially. That move would not necessarily reflect new information. it would reflect forced behavior. Second, leverage dynamics. Silver is structurally prone to over-leveraged retail participation, volatility-based margin hikes, forced liquidation cascades. If downside momentum accelerates, margin requirements are likely to rise. Weak hands exit, open interest contracts sharply. This can push price significantly below what fundamentals would suggest is fair value. Third, spillover risk. Bearish resolution would likely coincide with broader risk-off behavior, dollar strength liquidation across commodities, and temporary strength in cash and short-duration instruments. This is not a silver-specific failure. It's a liquidity event, and historically, these events tend to resolve faster than bullish trends, but more painfully. 10. What the market may be missing. Here's the part that doesn't show up clearly on charts. Silver's market structure contains incentive mismatches. Producers want price stability. Industrial users want supply certainty. Traders want volatility. Central banks want credibility. Those incentives are not aligned. What the market may be underestimating is the fragility of paper liquidity relative to physical demand, the non-linear impact of margin policy changes, the lag between physical tightness and futures repricing, and the political sensitivity of commodity inflation. Silver does not need to run out physically to stress the system. It only needs delivery friction at the margin. Those stresses rarely announce themselves in advance. They appear suddenly, often during periods of apparent calm. 11. The role of Asia versus Western markets. This divergence deserves specific attention. In Western markets, silver trades as a speculative instrument, prices driven by futures flows, ETFs, and options. Volatility is both a product and a weapon. In many Asian markets, silver trades as a savings vehicle and industrial input. Demand is less sensitive to short-term price swings. Premiums matter more than spot price. During consolidations like this, Western markets often lose interest. Asian demand tends to accumulate quietly. Physical flows shift without headline attention. This does not guarantee higher prices, but it builds asymmetry. When paper markets eventually reprice, they often do so against a backdrop of reduced available inventory. 12. Liquidity, not conviction, drives the next move. This is the core takeaway so far. Silver is not waiting for a narrative. It is waiting for liquidity to break. That break can occur above resistance via short covering or below support via forced liquidation. Conviction follows price, not the other way around. Right now, both sides are exposed. That is why consolidation is dangerous. 13. Decision points. What actually matters from here. At this stage, analysis becomes less about interpretation and more about response. Silver is compressing. That compression will not resolve evenly. The market will be forced to choose, and that choice will be visible before headlines catch up. The first decision point is price acceptance, not wicks, not intraday spikes. Acceptance. Does price hold above $80 for multiple sessions with expanding volume? Or does it fail, slipping back into the range and exhausting momentum? The second decision point is volatility behavior. Watch not just price, but how it moves. Expanding ranges suggest stress. Compressed ranges suggest positioning is still being built. Sudden gaps signal forced behavior, not informed positioning. The third decision point is cross-market confirmation. Silver rarely moves alone at inflection points. Watch real yields. The dollar's reaction to data, not the data itself. Credit spreads. Other industrial metals. When silver diverges meaningfully from those inputs, something structural is usually happening. 14. Short-term traders. Risk is front-loaded. Here for short-term participants, this is not an environment that rewards prediction. It rewards discipline. Range-bound markets are where leverage quietly destroys accounts. Key principles here: size small relative to volatility. Define invalidation before entry. Respect that false breaks are common in compression phases. Above $80, momentum strategies gain probability. Stops must be wide enough to survive noise. Expect violent pullbacks even in bullish resolution. Below $70, liquidity thins fast. Slippage increases, emotional decision-making becomes costly. Silver does not trend cleanly at turning points. It tests resolve. 15. Long-term holders, structural thesis versus price action. For long-term holders, this consolidation changes very little structurally, but it changes how patience is tested. The long-term thesis remains grounded in monetary debasement over cycles, not weeks. Structural underinvestment in mining, growing industrial demand, especially from energy transition sectors, fragility of paper claims during systemic stress. However, long-term conviction does not exempt anyone from volatility. This is where mental framing matters. If your thesis depends on near-term price appreciation, it is not a long-term thesis. If your thesis accepts volatility as the cost of holding a non-yielding, non-credit asset, then consolidation is not failure, it is process. That said, concentration risk and opportunity costs still matter. Even long-term holders should remain aware of portfolio balance liquidity needs and the possibility of deeper drawdowns before Resolution 16, margin policy, the silent catalyst. One element that deserves explicit mention is margin policy. Silver has a history of being managed not through price suppression, but through risk controls. When volatility rises, exchanges raise margin requirements. Leverage becomes expensive overnight. Forced selling follows, regardless of conviction. This has ended more silver rallies than fundamental weakness ever has. Margin hikes do not invalidate a bullish thesis, but they delay it, and they tend to occur after volatility increases, not before. That asymmetry catches traders off guard every cycle. 17. What would change the long-term outlook? This is an important question and one that often goes unanswered. What would actually damage the long-term silver thesis? Not a pullback, not consolidation, not even a deep drawdown. It would take something more structural, such as sustained monetary discipline across major economies, a durable resolution to fiscal imbalances, or a technological substitution that materially reduces silver demand. At present, there's limited evidence for any of those. That does not mean prices must rise now. It means price and value remain decoupled in the short term. 18. Key takeaways, 3 to 4, only. First, silver is consolidating, not failing. Compression increases the probability of a violent move, not a gradual one. Second, liquidity, leverage, and margin policy, not narratives, will determine the direction and speed of the next move. Third, bullish and bearish resolutions are both plausible from here. Confirmation matters more than conviction. Fourth, time horizon defines interpretation. What is noise to one participant is existential risk to another. 19. Unresolved tension. What the next phase will decide. The market is approaching a point where indecision becomes instability. Over the next several sessions, 2 weeks, watch whether $70 holds under stress, whether $80 is accepted or rejected, how volatility behaves on moves, not pauses, and whether macro inputs confirm or contradict silver's direction. Silver does not stay quiet for long. When it moves, it rarely gives second chances. 20. Responsible close silver is one of the most emotionally traded markets in the world. That alone should encourage restraint. No asset owes anyone a move. No thesis unfolds on a schedule. And no amount of conviction substitutes for risk management. Whether you are trading the range or holding for structural reasons, the priority here is clarity, not urgency. Know your time frame, know your risk, and let the market confirm before you commit, this consolidation will resolve. The only open question is who is positioned to survive it.